Greetings, everyone. My name is Thomas Gorman, and I'm the Client Success Coordinator here at the Client Fund. Today, the Elevation series is back with some more critical information for entrepreneurs. Today's presentation is called Strictly Business, Never Personal, Separate Your Funds. Now, when you're starting a business, one of the first critical financial habits to adopt is keeping your business funds separate from your personal funds. It might seem convenient to mix the two, especially in the early stages when cash flow is tight. However, this practice can lead to complications that may hurt your business's growth, impact your personal finances, and even create legal and tax issues. By maintaining a clear distinction between the business and personal expenses, entrepreneurs can streamline financial management, ensure accurate reporting, and protect themselves from potential liabilities. Now, from a practical standpoint, separating funds makes it easier to track business performance. You'll have a clear view of how much revenue your business is generating, what its expenses are, and whether it's truly profitable. This is essential when you need to apply for loans, secure investors, or just make strategic decisions. It also simplifies the process of tax filing as you can easily identify deductible business expenses. The separation reduces the risk of errors and ensures compliance with tax regulations, which can be a headache when personal and business funds are mingled. On a more personal level, separating finances protects you from legal risks. If your business faces a lawsuit or goes into debt, mixing personal and business assets could potentially put your personal property at risk. This is especially important for sole proprietors or entrepreneurs without a separate legal entity like an LLC or corporation. Keeping business funds separate helps reinforce the legal distinction between the business and its owner, providing a level of protection to your personal assets. In the long run, it sets a foundation for sound financial management, improves your credibility with banks and investors, and keeps your business on the path to sustainable success. As we dive into this topic, we'll explore practical strategies for achieving financial separation, such as setting up dedicated business accounts, using accounting software, and understanding the implications of mixing personal and business funds. By adopting these practices early, entrepreneurs can ensure smooth operations and avoid common financial pitfalls that could hinder their success. And so let's take a look and see why it is important to separate your business funds from your personal funds and really taking a deep dive into this issue. In today's presentation, we're going to explore the key reasons why small business owners should never, ever mix personal funds and business finances, and how doing so can lead to complications. Now, first, let's address the issue of what is commingling funds. So, commingling funds means mixing your business's money with your personal finances. This can happen in several ways. And, one of the most common ways that we see this done is by depositing client payments intended for your business into your personal bank account. Um, Bad idea. This is not something you want to do. Um, all of the money that your business generates should be deposited into a business account and left in that place. Um, Withdrawing funds from your business's account to cover personal expenses without any proper records. Using personal money to cover business related costs, using the same account for both business and personal transactions, writing checks from your business account to pay for personal expenses, charging business expenses to your personal credit to earn cash rewards, and frequently transferring money between your business and personal account without keeping proper documentation. All of these items are examples of what it means to commingle funds. And those of us who have been to business school might take this for granted, but for inexperienced entrepreneurs, This might not seem very apparent. Um, you know, a new entrepreneur might think, well, as long as my money is in a bank account and safe, what's the big deal, right? Well, as we move forward, we're going to explore what the big deal is. But this is something that every young entrepreneur or every inexperienced entrepreneur needs to have this information because it can save you so many headaches. So let's move forward. Now, before we get into the whys, we need to examine why do we incorporate our businesses? Um, you know, Incorporations have been around for quite a long time and they've evolved. We've got C Corps, we've got S Corps, we've got LLCs, and there's a few other ways that we can incorporate our businesses. But why do we do it? Well, there's a few reasons, and they are all extremely important. The first reason is to create a separate legal entity. Now, when a business is structured as an LLC or a corporation, it is treated as its own legal entity. This means that it can own property, enter contracts, and incur debts independently of its owners. So think about that. You are the business owner. You run the business every day, but yet the business is its own entity, its own legal entity that can own property, enter contracts, and incur debts. So we can say this has separated the individual from the individual's business. And that is very important. The second reason is the protection from business debts. Now, if the business takes on debt or faces financial trouble, creditors can only go after the company's assets if it's incorporated or protected with some type of limited liability protection, not the owner's personal belongings like their house, car, or savings. Another reason, lawsuit protection. If the business is sued, the liability is typically limited to the business itself. Owners' personal assets remain protected unless they engage in fraud or personally guarantee a loan. Now, some of those ways that we just talked about, that you can commingle funds, are pretty close to being fraudulent, like taking money that a client paid you and depositing it directly into your personal account. If you make that a continuous habit and you do not report that money, that's fraud. And you will not receive the protection that the LLC or the incorporation is intended to give you if you go down that path. And the last reason is bankruptcy protection. Now, if the business goes bankrupt, owners are not personally responsible for repaying the business's debt unless they have personally guaranteed them. And generally speaking, that's not the case unless you are have personally guaranteed a loan or something along those lines. So this is why we incorporate our business. It's a level of protection that insulates us and our personal assets from any business dealings or business debts, contracts, etc., that the business may engage with or enter into. And so that brings us to the first big risk of commingling funds, and that is the legal risk. Because mixing personal and business funds can blur the lines between your personal and business entities. And when that happens, it puts your personal assets at risk. Now, the term corporate liability shield is fairly common, um, and it's very metaphorical. The LLC or the incorporation that you apply to your business gives you a shield. It shields your personal assets from your business dealings. It keeps those entities separate. And if anything happens to the business, they cannot come after your personal assets. They can only go after the business assets. And so that in and of itself should be enough reason for us to not mix business and personal funds, because you're putting every personal asset that you have at risk when you do that. Or at least you start chipping away at the protections that you pay for with the LLC or incorporation. So, in the event of a lawsuit or debt, if your finances are intertwined and that can be proven, the creditors may target your personal assets. So, keeping funds separate helps maintain the liability protection offered by forming an LLC or corporation. Now, this image really illustrates what the corporate veil is, or the corporate shield. Um, you can see on the left side of the screen, we have a client or somebody outside the organization who wants to sue the organization. Now, under the little shop there, we can see it's labeled no money because the business is in poor financial straits. Now, if that's the situation and you have been recording your minutes and your filings, if you've been separating business and personal assets, the incorporation or the LLC is going to shield you or shield Joe, who is the business owner, from the lawsuit being filed by Clark. However, once you start mingling business funds with personal funds, that shield is immediately being chipped away at. It's saying what you're basically saying is there's not a difference between the company and the owner. You're saying these are the same entity. And that goes directly against what we were trying to accomplish by incorporating with the LLC or the S Corp or the, et cetera. It goes directly against the logic of doing that. So, it may not seem like a big deal. You may put all your money in one bank account and say, well, it's secure, it's okay. But understand when you're doing that, every time you do that, you are chipping away at the protections afforded to you by the LLC. Um, and you know, if you ever have ambitions of building your personal wealth and handing it down to the next generation of your family, you need to understand that mixing business funds with personal funds is a threat to that goal. Um, so just keep that in mind. Now, another reason why we should shy away from maintaining or from mixing personal and business funds is to maintain a clear financial picture. Separate accounts make it easier to track business income and business expenses, which is essential for accurate reporting. And having distinct records helps you make informed decisions, ensuring that your business stays on track. And all of this clarity is crucial when applying for loans or attracting investors. Now, you if you are making transactions, business and personal, out of one account and you do it for the entire month, it may be difficult to look back and say, well, this was business related and this was personal related. And so then how can you ever create good financial records? How can you make an actual profit and loss that is accurate when these expenses are commingled? You have to separate them in order to get good reporting. And the more you do it, the more difficult it becomes to separate the funds that have been mixed together. Um, and so if you can't if you can't create accurate reporting, well, this is going to directly affect your ability to make sound business decisions. If you guys have been following the elevation series, um, you know how big we are on using your financial statements, your profit and loss, and your balance sheet to guide your decision making inside of your business. But that becomes impossible when the statements aren't accurate because the funds have been mingled. Um, and so right off the bat, we can see, this is just making things more difficult from you as a small business owner. And then, at some point, if you expect your business to grow and that is your goal, at some point you're going to have to look for additional financing, whether that is through loans or through investors, um, whatever the case may be. When you go to engage in the fundraising, whoever you're raising the funds from is going to want to see bank statements. They're going to see profit and loss and balance sheet. And when they realize that you're mixing business and personal funds, they're likely to walk away immediately because they know the implications to this. Um, so it's gonna mixing business and personal funds is going to make it easier for you to create accurate reports. It's going to muddy the waters with regards to how you make decisions. And it's also going to impair your ability to raise money for the growth of your business in the future. So, the evidence is piling up pretty quickly here that this is just something that every entrepreneur needs to avoid. Um, Another way that mingling your funds can negatively affect your business and personal life is through tax compliance. Keeping these funds separate really simplifies tax preparation. Um, Mixing business and personal funds is always going to make tax filings more complicated, um, and it's going to lead to potential errors and missed deductions, which is going to cost you money. Um, The clear separation of funds ensures you're compliant with tax laws and makes it easier to claim deductions specific to your business expenses. Um, every small business owner knows we want to claim as many expenses against our income as we can. But you have to be able to prove that those were business expenses. And as we've discussed, when you're mingling funds, you're saying, well, there's not a difference between my personal assets and my business assets. You're tearing the wall down between them and everything gets lumped together. So it negatively impacts your ability to claim business expenses. And keeping your funds separate also helps avoid penalties or audits from the IRS due to improper reporting. Claiming personal expenses as business expenses can raise alarms with the IRS. If you're audited, you could end up with penalties, interest charges, and potential legal consequences. Plus, it can lead to a higher tax bill. So, on the one hand, we see how commingling funds can make it more difficult to deduct all of your business expenses from your revenue, and that affects your bottom line. And on the other side, we see that if you are doing this and the IRS picks up on it, you can be hit with penalties, interest, and legal consequences that also affect your bottom line. So on both sides of the fence here, this is a negative impact to your business. Another way that mingling funds can have an impact on your business is with regards to cash flow. Mixing funds can distort your view of your actual business cash flow, making it difficult to assess profitability. Accurate separation allows for better budgeting, forecasting, and ensures you're not overcommitting personal funds to cover business expenses. And who really wants to do that anyway? We don't we don't start a business so that our personal um, finances support the business. No, we want the business to support our personal finances. So, if you're in a position where you're having to use personal funds to cover business expenses, well, things are already going sideways, and you're just compounding the issue when you start, siphoning off of your personal funds to pay business expenses. So keeping them separate helps ensure you can cover operating costs without jeopardizing your personal finances. And, you know, we need to know on a personal level how much money we have coming in every month and how much money we have to kick out every month. And on a business level, we need to know how much money we're bringing in every month and how much money we're paying out every month. Without that information, we can't even really do a budget. Um, so this is yet another reason why this is just a bad idea. Business credit is something that every new business is trying to establish. Lines of credit, business credit cards, all of these things give business owners flexibility with their cash flow. If you have a slow month, but you have a line of credit, you can use that line of credit to kind of get your inventory back where it needs to be, um, or whatever the case may be, whatever you need to use that credit for. Um, and so keeping business and personal funds separate allows you to build credit for your business. Um, but that can only happen if you're establishing a business credit history. And establishing a business credit history is essential for securing financing, negotiating better terms, and growing your business. But mixing your funds makes it harder for lenders to assess your business's financial health. So immediately upon um, opening up your business, or maybe not immediately, but in the first year, you may want to start working on building the business's credit. And a great way to do that is to apply for a business credit card and use that business credit card to pay for your business expenses, um, and pay it off immediately. But if you're mixing, if you're using your personal credit card for business expenses, then you're not doing anything to build business credit. You might still be building your personal credit through paying off charges, but you're not doing anything to establish credit for the business. And I think every business, even if they don't use the credit that they have, every business wants to have some kind of line of credit, some way to be able to quickly access capital in the event of emergency. Um, so, this is yet another way that mingling funds is going to negatively impact your business. And earlier, we spoke about when the time comes to grow the business, you're going to have to reach out to investors and vendors and things along these lines. Um, and when they realize that you're mixing business and personal funds, well, they're not going to feel incredibly comfortable with that. And in fact, they're going to find it to be really unprofessional. Um, you know, Legitimate businesses do not mix business and personal funds. This is something that a hobbyist would do. You know, if you build fishing poles and sell them on the side, that's the type of endeavor that you would mix business and personal funds, because it's not a business, it's just a hobby. And if you're continually mixing business with personal, that's how you're going to be viewed, as just a hobbyist. You're not going to be viewed as a legitimate business entity because you're not acting like you're a legitimate business entity. So keeping those funds separate helps to keep a clear financial structure, And that signals professionalism to clients, investors, and vendors. It helps establish your business as a legitimate entity, enhancing trust and credibility. And it also ensures that you can meet financial obligations without complications, helping to build a strong reputation. And at the end of the day, no business wants to have a weak reputation. Um, so keeping those funds separate can create trust with investors. It can give you the image of being a professional business entity. Um, so keep that in mind as you move forward as well. It's not all about the bottom line, but about perception as well. And so then we might come to the question of, well, how do we keep business and personal funds separate? Well, this is very easy. There are so many options out there to help you with this. First and foremost, you want to open a business checking account and use it exclusively for business transactions. Um, Never, ever, ever just start putting business funds into your personal account. As we said earlier, that can be seen as fraudulent and can lead to legal consequences. Um, Secondly, as we mentioned a few minutes ago, you want to apply for a business credit card to track business related purchases and expenses. Keep that separate from your personal credit cards. One for business, one for personal. Never mixing the two, always keeping them separate simplifies everything. Additionally, use separate accounting software to keep track of business and personal finances. And this is something that I did, when I was a business owner. I used QuickBooks to keep all of my business transactions in, income, expenses, everything. And then I had my own separate spreadsheet that I built for my personal finances. Um, because I mean, honestly, I we should all kind of view our personal finances in a business-like way, always making sure that we have more coming in than we are going out, and keeping everything in balance. And that becomes really difficult to do when everything is combined. And then lastly, um, pay yourself a salary or draw from your business account to ensure clear separation. So ideally, you would give yourself a weekly or a bi-weekly salary or paycheck. Um, and you would, write a check and deposit it into your personal account. Now, maybe your business is not yet producing um, enough revenue to justify giving you a paycheck on a consistent basis. And that's okay. Sometimes you have to make sacrifices early on in the life of a business to help it, you know, get on a solid foundation. But at some point you do have to pay yourself. And the important thing is to just make it clear that this money came out of the business account and it was paid to you as compensation for your work inside the business. And that's all. If you're doing that, then you're doing the right thing. So, in conclusion, this is a really really important piece of information for all newer entrepreneurs. It might seem like a simple thing, but if you've never been exposed to this information, you just don't know. And when you're a first time business owner, you just don't know what you don't know. And so that's why we're doing this video today, because this is very important for you guys to understand that mixing business and personal funds can lead to legal, financial, and tax related complications. Um, Separating your finances protects your business, improves financial decision making, and simplifies compliance. And take the steps now, early on, create the good habits to establish clear boundaries and ensure the long-term success of your business. Um, it, for you guys who this is your first business, it's going to be a learning experience. Um, but the thing is, you want to learn the lesson and then you want to apply it. Don't keep making the same mistake over and over and over again. You know, the more you do that, the more you're going to pay for your mistake. So I hope this has been helpful. I hope this has brought some clarity to this topic for you guys. So I'm going to go ahead and wrap this up, but I appreciate everybody tuning in today. We'll see you next time on the Climb Fund Entrepreneurial Elevation Series. Thank you so much.